Hello, it's Peter Stimson here from MPowered Mortgages. It's Tuesday the 14th of October and swap rates have actually fallen in the last couple of days. Now, if that sounds probably a slightly surprising statement, it's because the last 3 months have actually been incredibly benign. The swap rate graph we're sticking up now shows you swaps on the 2, 5 and 10 year since Liberation Day, or 1st of October, or 1st of April, sorry, as most of us will be aware, which is when Donald Trump introduced the tariffs. Last 3 months, swaps have been kind of bumping around a bit and have probably gone up slightly. And lenders have probably adjusted pricing up a little bit from that side of things. But the market's really not done very much. Swaps last couple of days have come down, and they've come down for a couple of reasons. First of all, they've come down today, particularly because of the wage data that's come out. Wages started the year around about 6%. Data out today has shown they've come in at 4.7%. And they're coming at 4.7, which is where the Bank of England was expecting them to come in at, which is important. Second factor, and the graph we're sticking up now shows you job vacancies, and it's job vacancies going back to 2015. Now, if you look at the job vacancies, they kind of peaked in 2022 at around 1.1 million, and they've dropped ever since that point in 2022, and we're now down to about 600,000, and they're still falling for 39 months in a row now. Now, that's obviously an indication of a cooling economy. Economy probably in 2022, this is kind of coming out of COVID, was overheating a little bit. That's probably not a great sign that the economy's in a great shape, although the number of job vacancies is probably going back to where it were if you look at the graph from that kind of side of things. What does that tell you? Well, it tells you that inflation looks like it's kind of getting back under control with wages coming back down. The economy is kind of slowing from that side of things. So it means that, things are right for another bank base rate cut at some point. The question is really when that happens. November is almost certainly likely to be too soon. December, at this stage, looking out, it really depends how CPI prints in the next couple of months. My best guess is probably December doesn't happen, in which case it's likely to probably be February. After February, my best guess is we get another cut after that. Now, the two cuts that I'm guessing, or the market is largely predicting, are already priced into the swap curve. So when you're looking at, 2-year SONIA swap being around 367, bank base at the moment being around 4%, that is priced in. So even if those two cuts do occur, you're unlikely to see that much change to mortgage pricing, given that it's already priced in, like I say. If the economy continues to deteriorate, or there's some other sort of shock economic news, not in a good sense, rates could potentially fall further, although it really depends on the big thing being inflation. That's it from here. If anything else changes, we'll let you know.